Welcome to This Explainer. Today, we're going to demystify a massive transition that's happening right under our noses. Look, when you think of NVIDIA, you almost certainly think of silicon, right? You picture the physical hardware, those highly coveted GPUs that are literally powering the entire generative AI revolution. But over a really short period of time, that core narrative has fundamentally shifted. NVIDIA is actually transforming from just a brilliant hardware designer into a massive financier of the AI ecosystem. So today, we're going to unpack exactly what this means for the market, the very real risks involved, and what you absolutely need to know to navigate this entirely new financial landscape. Let's get into it.
Okay, let's dive into this rapid evolution by looking at a dramatic 1-2 punch that happened just weeks apart this past August. It honestly shattered a lot of preconceived notions about the company. On August 10th, NVIDIA announced a sprawling strategic partnership with 6 of the heaviest hitters in global finance. I mean, we're talking Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The goal? To mobilize over $500 billion in third-party capital. Then, literally just a week later, on August 17th, we got a massive SEC filing that showed us exactly what this capital mobilization looks like in the real world.
And here is the absolute jaw-dropper from that filing. $105 billion. The SEC documents revealed that NVIDIA has effectively put a staggering $105 billion guarantee behind a single OpenAI data center over in Ohio. I mean, just let that sink in for a second. NVIDIA is no longer just selling the picks and shovels for the AI gold rush. They're essentially stepping up to underwrite the mines themselves. Which brings us to Section 1, the bull case, and why Wall Street is staying bullish. So despite this massive new exposure and what is, frankly, a totally new risk profile, a lot of top analysts are holding the line. When you look at the valuation context, despite all those crazy headlines and this new financier role, NVIDIA is actually trading at a forward price-to-earnings ratio of roughly 16 times. To put that into perspective, over the last 5 years, their PE ratio has averaged around 57 times. So mathematically speaking, NVIDIA is currently trading at a huge discount compared to its own historical averages. For the bulls, at these levels, the stock looks like an absolute steal. Bank of America actually hit the nail on the head here, arguing that the broader market is over-penalizing NVIDIA for stepping into this new financing role. To back up that optimism, they reiterated a super powerful buy rating on the stock, setting a highly ambitious $350 price target. Their core argument is that NVIDIA is operating from a position of profound strength. They literally call it a cash flow fortress. They aren't scraping the bottom of the barrel to fund these initiatives. They're leveraging overwhelming financial success. And the sheer scale of that operational strength is staggering. Analysts estimate that NVIDIA is going to generate a combined $470 billion in free cash flow over 2026 and 2027 alone. So the crucial point of the bull thesis is this. NVIDIA isn't out there gambling its day-to-day operational cash on risky startup ventures. Instead, it's using this absolutely enormous fortress of a balance sheet to secure and basically guarantee its future monopoly over AI infrastructure for the next decade. Now, this fortress balance sheet also serves as a massive defense against a major fear that's circulating in the market right now, the whole concept of circular financing. Critics look at NVIDIA's actions and worry, hey, are they basically just funding their own customers to buy their own chips? It's a risky behavior that heavily echoes the lead-up to the dot-com crash. But here's how NVIDIA is mitigating that exact credit risk, by offloading it to those Wall Street giants we mentioned earlier, like BlackRock and Apollo. They're working to create a completely new asset class where GPUs are treated like hard assets. Think commercial real estate or commercial aircraft, complete with robust residual value. If a customer defaults, NVIDIA isn't taking the whole hit. Institutional Wall Street is sharing that burden. But we have to look at the other side of the coin. Section 2, the bear case and the weight of the balance sheet. Investment theses can't be built on optimism alone, so what's keeping the bears up at night? Well, the crucial point here is the sheer, mind-boggling scale of the liabilities involved. While that $500 billion platform we talked about utilizes third-party capital, NVIDIA themselves have a staggering $300 billion in direct off-balance sheet commitments. As you can see in this breakdown, that includes about $70 billion in equity investments and a massive $230 billion tied up in value guarantees or financial backstops. That is a ton of hidden weight that just isn't immediately obvious on a standard balance sheet. And the most glaring concrete example of this risk brings us right back to that Ohio data center deal for OpenAI. That SEC filing explicitly showed NVIDIA guaranteeing the lease for a massive 4.25 gigawatt facility. To put that in perspective for a second, that's enough electricity to power a few million average homes. Sure, OpenAI has agreed to reimburse NVIDIA for payouts, but you gotta ask the hard question. What happens if OpenAI hits major financial trouble? Or even more broadly, what if the overall demand for AI just cools down? If that happens, NVIDIA is explicitly on the hook for up to $105 billion, potentially left holding the bag for depreciating massively capital-intensive assets. And listen, this isn't just theoretical fear-mongering. The credit markets are actively reacting to this immense concentration risk right now. Analysts are watching NVIDIA's credit default swap spread widen out, which essentially means the real-world cost to insure against an NVIDIA default is rising. The credit markets are paying very, very close attention to this exposure, and they're beginning to question the fundamental quality of NVIDIA's earnings. They're asking if the company's cash flows are becoming entirely too tangled up in highly complex financing structures rather than the clean, pure semiconductor sales that originally made them such a powerhouse. Moving on to Section 3, Smart Money and Stock Technicals, Accumulation versus Distribution. So with the fundamental bull and bear cases showing such a sharp divide, we really have to look at what institutions and insiders are actually doing with their capital right now. Behind the scenes, a fascinating market tension is playing out. On one hand, you have major funds accumulating shares, resulting in institutional investors still owning over 65% of the outstanding shares. That is a massive, undeniable vote of confidence from the big players. But on the flip side, company insiders and executives have quietly offloaded $1.7 billion in stock over the past year. Now, executives sell for tax and liquidity reasons all the time, but $1.7 billion? That's a significant number. It definitely suggests that those closest to the company's daily operations are taking some chips off the table while the stakes are getting higher. Technically speaking, we're currently seeing the stock consolidate, hovering right around $219 a share. Analysts note that there is a path forward. For instance, RBC Capital has set a breakout target at $270 per share. But to break out of this current holding pattern and hit those new highs, NVIDIA has a huge hurdle to clear. They absolutely must prove to generalist investors that this complex new financing model is a powerful feature of their business and not some catastrophic liability, especially as the broader AI trade gets more and more crowded. Which brings us to our final part, Section 4, the synthesis, the August 26th catalyst. All of this institutional tension, all of this intense market debate between the bulls and the bears builds up to one ultimate climax for the market. NVIDIA's highly anticipated second quarter earnings report on August 26th. Now, when that report drops, the headline numbers are going to be flashy. Wall Street widely expects Q2 revenue to land somewhere between $94 and $95 billion, easily beating NVIDIA's own official guidance of $91 billion. But here's the secret. A top-line revenue beat is almost entirely expected at this point. For savvy investors, the raw revenue numbers simply aren't the real story of this earnings cycle. The real story is going to happen on the conference call itself. Here are the 3 highly actionable things you need to be listening for to truly understand how management is navigating this high-stakes transition. Number 1, disclosure. How transparent is management about the accounting for that $105 billion Ohio guarantee? Number 2, the AI pipeline. We need to hear clear, undeniable signs from management that the infrastructure boom is still accelerating and not hitting a pause. And number 3, China stability. Listen closely for how NVIDIA is navigating export controls, specifically regarding reports of small H200 chip shipments reaching major players like ByteDance and Tencent. Stability there could be a massive tailwind. At the end of the day, NVIDIA is in the middle of a profoundly high-stakes transition, leveraging unmatched profitability to dig a competitive moat so deep no one else can even think about crossing it. But as Jensen Huang takes the stage, no longer just as a tech CEO, but really as the new banker of the AI revolution, you have to ask yourself one vital question. Is this transition the ultimate visionary competitive moat that will secure their dominance for a decade, or are we looking at an unprecedented, multi-billion-dollar financial vulnerability? Keep your eyes on the data, because understanding this shift is absolutely the key to understanding the future of AI. Thanks so much for joining this explainer, and we'll see you next time.